Stocks sinking ahead of the close today as concerns about higher for longer interest rates put a damper on investor spirits. New York Fed President John Williams may be easing some concerns, saying he expects inflation to start coming down again in the second half of the year. For more on the Fed's path moving forward, I want to welcome in now Bob Elliott, Unlimited co-founder, CEO, and CIO. Bob, it is great to see you. So why don't we start there, Bob? So, John Williams did make some headlines today. He did say inflation is still too high. Goes on to say, Bob, I don't feel any urgency or need that I don't feel any urgency or need that we have to make a decision now, he said. What do you make of those comments, Bob? What do you make of where the Fed goes from here?
Well, I think given all the noise of the commentary, people often think that the Fed is likely to be more active in terms of shifting its policy mix than the reality. Most central banks, when they've been on pause for an extended period of time and aren't seeing meaningful shifts in the macroeconomy, the way that the Fed is seeing now, inflation still a little too high, underlying growth still pretty good. The inclination is to pause and do nothing and gather more information. And I think that's basically what we've seen through the whole slew of these Fed speakers over the course of the last couple of days, where basically all of them are pointing to the fact that it probably makes sense to just wait and see. Some of them are hoping for lower inflation. Some of them are maybe concerned that it might be a little bit higher, but wait and see is the key theme across all of them. And that means that, a meaningful cut cycle is probably not going to happen this year.
It's so interesting, Bob, because, a lot of market participants have sort of come to that view, despite whatever Fed funds futures are pricing in at one moment or another. We talk day in and day out about, the market is moving on this piece of data that the Fed is watching or this Fed speak. But like a lot of people are talking to are saying it doesn't matter if they cut this year. Stocks are almost agnostic to the Fed at this point. Do you think so?
For a period of time, it looked like stocks are agnostic, particularly at the beginning of the year as rate cuts came out and stocks rallied. But the key reason why that happened was that we had a resetting of growth expectations in the economy from coming into the year of below 1% growth to now expectations are that growth in the second through fourth quarter is going to be something like 3%. Each quarter on an annualized basis. That's very, very strong growth. Unlikely that we're going to achieve growth at quite that pace through the end of the year, combined with the fact that the Fed not delivering those cuts is going to put pressure on the bond market, discount rates, which is also a drag on stocks. And so I think we've transitioned. Really, after the first quarter, we've really transitioned to a point where a lot of the market action in stocks is really being driven by the bond market. And we've seen that, for the last couple of months.
Bob, I want to get your take on another trend, too. There's an interesting piece in the Journal today, Bob. I don't know if you saw it. Title was, "This Record Stock Market is Riding on Questionable AI Assumptions." Goes on to say how just 4 giant tech stocks added more market value than the rest of the SPX put together this month. Just generally, Bob, I'm interested to get your take on that AI trade. How confident, how bullish are you on it?
Well, I think days like today highlight just how sensitive the equity markets in aggregate are to the big AI trade. If you look at sort of the average stock, it's doing fine today, and the big stocks are dragging down the overall market. And so that highlights the fact that we do have a big trade on AI in the market and very, very elevated earnings growth expectations that come with it. If you look at the overall market, expectations are for 17% earnings growth at the S&P 500 level over the by the fourth quarter, 17% year-over-year earnings growth. That is extraordinarily high for an economy that has nominal growth of about 5%, 5 or 6%. The only way that that's going to happen is with these large AI players and large tech players gobbling up corporate market share and being able to increase their margins, and that seems like it's going to be challenging to meet those expectations. And, the feeling that we're getting today may be a more common occurrence over the course of the next 6 months.
So then, Bob, what's sort of your best play right now? Where are you looking, if not necessarily to add an AI-related stuff? Where are you going?
Well, there's across the equity market, it's a challenging environment to find things that look like they're of good value in the market relative to what's priced in. There's certain places that still look like they have some opportunities. The financials look to have some opportunities, and so taking advantage of some dips there is a place that is still so underpriced relative to the AI boom. And that's really, the primary area where I would be focusing on right now, given a bit of the sort of structural pessimism that has persisted in those assets for a while.
Bob, always great to have you on the show. Thank you, sir, for joining us.
Thanks for having me.